Getting started with investing feels a lot like trying to push a giant, heavy boulder up a steep hill. At the very beginning, every single inch of progress requires immense effort. You push, you sweat, and you strain with everything you have. But the boulder barely moves. You look back down the hill and see you've only traveled a few feet. It's exhausting, and it's easy to wonder if all this work is even worth it. This initial struggle is where most people get discouraged. They see the towering peak of financial independence far in the distance and feel that their small, consistent pushes are doing almost nothing to get them closer to their goal. It is a game of pure, raw willpower. This early phase is defined entirely by your own savings rate. The market's returns, while helpful, are almost negligible when your account balance is small. If you have $5,000 invested, even a fantastic 10% return is only $500 for the entire year. Meanwhile, you might be saving $500 every single month from your paycheck. Your personal contributions are doing all the heavy lifting. Your money isn't a partner yet. It's more like a toddler you're carrying on your back. It adds a little weight, but it certainly isn't helping you climb the mountain. This reality can be disheartening, as it feels like you are the only one working. The journey to your first significant milestone is a lonely one. It's a battle fought not against the market, but against your own impatience and doubt. You read stories about people with large portfolios whose money is making them wealthy while they sleep. But your own experience feels completely different. Your money takes weekends off. It goes on vacation. It barely seems to be working at all. The growth is so slow that it's almost imperceptible without squinting at your account statements. The temptation to stop pushing the boulder and just let it roll back to the bottom is always there, whispering that there must be an easier way to live. But here is the secret that veteran investors know. Everyone has to push that same boulder up that same initial hill. There are no shortcuts. The struggle is universal. The goal in this phase isn't to see explosive growth, it's to build the habit of saving, and to simply stay in the game. It's about proving to yourself that you can keep pushing, even when the results are not immediately rewarding. The number that often represents the top of this first, steepest part of the hill is $250,000. It's a point where the physics of wealth building begin to change in your favor, and the boulder starts to feel just a little bit lighter. Reaching your first $10,000 in savings or investments is arguably the most difficult financial milestone of all. It is a landmark built entirely out of sacrifice and discipline, with almost no help from the magic of compounding. Think about it. To get to $10,000 by saving $400 a month, it takes over 2 years. During that time, the market might give you a small boost, but the vast majority of that balance will come directly from your pocket. Every dollar in that account represents a dinner you didn't eat out, a vacation you postponed, or a gadget you decided not to buy. It is a monument to your own willpower. The math at this stage is brutally simple and often discouraging. If you manage to get an 8% return on your $10,000 portfolio, you've earned $800 over the course of a year. While that's certainly better than nothing, it can feel underwhelming when you're simultaneously saving $4,800 a year from your job. Your savings are contributing 6 times more to your net worth than your investments are. At this point, your money is not yet an employee working for you. It is more like an unpaid intern. It shows up, it learns a little, but it doesn't really move the needle. The entire operation still depends on you, the founder, showing up every single day. This is the phase where the temptation to do something, anything, is strongest. Because the slow, steady progress is so boring, people start looking for excitement. They might be tempted to gamble on a risky stock hoping for a quick win. Or they might try to perfectly time the market, selling at the highs and buying at the lows. These strategies are alluring because they promise a shortcut past the grind. They offer a way to make the boulder roll uphill faster. But more often than not, these attempts at cleverness backfire, setting you back even further than where you started. The first $10,000 isn't about being smart, it's about being patient. The true purpose of saving your first $10,000 is not the money itself. It is the formation of a habit. It is the process of building a system in your life where saving becomes automatic. You are training your financial muscles. Just like your first few weeks at the gym are painful and yield few visible results, your first few years of saving are a grind. But you are not just accumulating money, you are accumulating discipline. You are proving to yourself that you can stick to a plan, and that foundation of habit is infinitely more valuable than the initial sum of money you manage to gather. It is the bedrock upon which all future wealth will be built. The journey from $10,000 to $100,000 is often called the long slog for a good reason. It's a phase where you've proven you can save, but the finish line still feels impossibly far away. The numbers are getting bigger, but the feeling is largely the same. Your savings are still the primary driver of your portfolio's growth. Let's say you have $50,000 invested and are contributing $10,000 per year. An average 8% market return on that $50,000 would give you $4,000 in growth. This is nice, but your own contributions are still more than double what your money is earning on its own. The boulder is still heavy, and you're still doing most of the pushing. During this stage, your financial life can feel like you are walking through a dense fog. You know you are moving forward, but you can't see the destination. The milestones are spread far apart. Going from $50,000 to $60,000 feels like it takes forever, and the psychological reward is minimal. You are no longer excited by the novelty of investing, but you are not yet reaping the significant benefits of compounding. You are in the messy middle. It is in this long, drawn-out period that many people begin to question their strategy. They wonder if they should be more aggressive, or if their slow and steady approach is fundamentally flawed. It's also a time when life tends to happen. During the years it takes to get to $100,000, you might want to buy a house, start a family, or change careers. These major life events can create new financial pressures that compete directly with your savings goals. It becomes a constant balancing act between living your life today and investing for your future. The temptation to reduce your savings rate to pay for a wedding or a down payment is immense. Sticking to your plan during this phase requires a deep-seated belief in the long-term process, even when the short-term evidence of its success is sparse and unconvincing. However, something important is happening beneath the surface. Even though your contributions are still the star of the show, your investment returns are starting to become a meaningful supporting actor. That $4,000 in earnings on a $50,000 portfolio is not a life-changing amount of money, but it is real. It's the equivalent of getting a small raise at work without having to do any extra work. It's the first tangible sign that your money is starting to pull its own weight. You are slowly but surely building a workforce of dollars, and while it's still a small team, it is beginning to contribute in a way that you can finally start to measure and appreciate. There isn't a universally magic number in finance, but $250,000 comes very close. It is a critical inflection point, a moment where the entire dynamic of wealth creation begins to shift in a powerful and noticeable way. It's the point where the boulder you have been pushing up the hill with all your might reaches a gentler slope. Suddenly the effort required to make it move forward decreases, and its own momentum starts to help you. The journey is far from over, but for the first time, you don't feel like you are doing it all by yourself. Your money has finally grown up and started contributing to the household income. Why this number? It's all about the relationship between your savings and your investment returns. For many middle-income households, saving between $15,000 and $25,000 per year is a significant but achievable goal. It requires diligence and sacrifice, but it's possible. When your investment portfolio reaches $250,000, something incredible happens. The annual growth from your investments begins to equal or even exceed the amount you are able to save from your paycheck. This is a monumental turning point. It feels like you've hired your first full-time employee whose only job is to make money for you, 24 hours a day, 7 days a week. Imagine you are saving a very respectable $20,000 per year. When your portfolio is small, that $20,000 is the only thing that matters. But once you have $250,000 invested, a simple 8% average market return will generate $20,000 in growth. This means you have effectively doubled your savings rate without cutting back on your lifestyle or working a single extra hour. You are now saving $40,000 a year, $20,000 from your labor, and $20,000 from your capital. This is the moment when you truly stop just saving money and start building wealth. Your personal effort and your money's effort are now balanced partners. This partnership changes everything. It reframes your entire financial picture. Before, your wealth was a direct reflection of how much you could resist spending. After this point, your wealth becomes a reflection of how well you can let your money work on its own. The focus shifts from pure brute force saving to patient long-term stewardship of your capital. You start to think less like a laborer pushing a boulder, and more like a farmer planting seeds. You've done the hard work of clearing the field and planting the first crop. Now you get to watch it grow, knowing that each harvest will be bigger than the last. Let's break down the simple, beautiful math that makes the $250,000 milestone so powerful. We'll use round numbers to keep it clear. Imagine a diligent saver named Alex, who works hard to save $20,000 every year. When Alex first starts, that $20,000 contribution is the engine of growth. After the first year, Alex has $20,000. An 8% return on that is just $1,600. Alex's own savings are more than 12 times as powerful as the market's return. The boulder is heavy, and Alex is doing all the pushing. Alex feels tired but keeps going, trusting the process. Fast forward several years. Through consistent saving and steady market growth, Alex's portfolio has finally reached the $250,000 mark. Alex is still saving the same $20,000 per year from their salary. But now, the math looks completely different. An 8% return on a $250,000 portfolio is $20,000. For the first time, Alex's money has generated the exact same amount of wealth as Alex's own hard work and sacrifice. A silent, invisible partner is now working alongside Alex, matching every dollar saved with a dollar earned through growth. The team has doubled in size, but Alex is still the only one putting in the hours. This is the tipping point where the system becomes self-sustaining and starts to accelerate. At the end of that year, Alex doesn't have $270,000, the original $250,000 plus $20,000 in savings. Alex has $290,000, the $250,000 plus $20,000 in savings plus $20,000 in growth. The next year, the returns will be calculated on this new higher balance. An 8% return on $290,000 is $23,200. Now Alex's money is out-earning Alex's savings rate. The invisible employee just got a raise, and it didn't have to ask for one. It just happened automatically, thanks to the power of compounding. This is why the initial grind is so important. You are not just saving money, you are building the capital base that will one day become your primary engine of wealth creation. The first $100,000 is hard because you are building the engine from scratch. The next $150,000 is still a slog, but you can hear the engine starting to hum. At $250,000, that engine finally roars to life, ready to do the heavy lifting for you. Your job shifts from being the engine to being the pilot, steering your financial ship toward its destination while the powerful engines of compounding propel you forward. Reaching $250,000 is like getting a snowball to the top of a very long, snowy hill. The effort it took to pack the snow together and roll it up the slope was immense, but once you get it to the summit and give it that final push over the edge, it starts to roll on its own. At first, it moves slowly, picking up just a little bit of extra snow with each rotation, but as it continues to roll, it grows larger and moves faster. The bigger it gets, the more snow it collects with each turn, and the faster it accelerates. This is exactly what happens with your investment portfolio after you cross the $250,000 threshold. The milestones start arriving faster and faster. Think about the time it takes to accumulate each $100,000. Getting from zero to your first $100,000 is the hardest and usually takes the longest. Let's say it takes you 8 years of diligent saving. The journey from $100,000 to $200,000 will be noticeably quicker, perhaps taking only 5 years, because now your initial capital is helping you. But the jump from $200,000 to $300,000 might take just 3 or 4 years. Your snowball is picking up speed. Before you know it, you might be adding $100,000 to your net worth every 2 years, and then every single year. This acceleration is deeply motivating. During the early grind, progress was so slow that it was hard to stay enthusiastic. You had to have blind faith in the process. Now, you have concrete evidence. You can see your account balance growing by amounts that would have seemed impossible just a few years prior. Seeing your portfolio grow by $30,000 or $40,000 in a good year provides a powerful psychological boost. It reinforces your good habits and makes you want to stick with the plan. It's no longer a chore. It's a rewarding game where you can see your score climbing higher and higher. This snowball effect is the core principle of long-term investing. Albert Einstein is often credited with calling compound interest the eighth wonder of the world, and this is why. It is a force of nature that, once it reaches a critical mass, seems to defy the normal rules of effort and reward. Your money starts to build on itself, creating a virtuous cycle of growth. The wealth you have creates more wealth, which in turn creates even more. This is how fortunes are built, not through brilliant stock picks or daring market timing, but through years of patient accumulation followed by an avalanche of compounding. One of the most profound changes that happens around the $250,000 mark is not financial, but psychological. Your relationship with money, risk, and the future begins to fundamentally change. Before this point, investing can feel like a fragile, high-stakes endeavor. A market downturn when you only have $30,000 invested can feel catastrophic. A 10% drop erases $3,000, an amount that might have taken you months of disciplined saving to accumulate. It's easy to feel like you are losing a game you can't afford to play, leading to panic and poor decisions. Your financial foundation feels like it is built on sand, but with a $250,000 portfolio, your perspective shifts. A 10% market dip still means a $25,000 paper loss, which is a much bigger number. However, it feels different, it feels less personal. You understand that this is just part of the process. You know that your portfolio's own earnings can likely recover that loss in a single good year. You have a large enough base that the natural volatility of the market feels less like a threat to your survival, and more like turbulence on a long flight. It might be uncomfortable, but you trust that the plane is still heading in the right direction. Your foundation now feels like it is built on solid rock. This newfound fortitude allows you to behave like a better investor. The greatest enemy of a good long-term plan is short-term fear. When you are no longer terrified of market downturns, you can stick to your strategy. You can resist the urge to sell everything in a panic when the news headlines are scary. In fact, you might even start to see downturns as opportunities. With a stable financial base, you can continue your regular contributions, buying more shares at lower prices, which will accelerate your growth when the market eventually recovers. Fear is replaced by a quiet confidence. This psychological stability also spills over into other areas of your life. The pressure to save every single penny begins to ease. You might feel more comfortable spending a little extra on a family vacation or a home improvement project because you know your financial future is not solely dependent on your ability to scrimp and save. Your investment portfolio acts as a massive financial safety net, giving you the freedom and flexibility to live a more balanced life. You are no longer just surviving, you are beginning to thrive, secure in the knowledge that you have a powerful financial engine working for you in the background. Market downturns are an inevitable part of the investing journey. They are the storms that every sailor must learn to navigate. When you are just starting out, these storms can be terrifying. A 20% drop in the market when you have $25,000 invested can wipe out $5,000. This might represent an entire year's worth of savings, gone in a matter of weeks. It's a gut-wrenching experience that can make you want to abandon ship and swim for the perceived safety of cash. Your emotional reaction is strong because the loss feels so significant relative to the effort you put in. Now, contrast that with the experience of an investor with a $300,000 portfolio. A 20% drop would mean a paper loss of $60,000. On the surface, that sounds much worse. It's a staggering amount of money, more than many people make in a year. Yet the experienced investor with a sizable portfolio often reacts with far more calm. Why? Because they have context. They have likely been through several market cycles already. They know that what goes down eventually comes back up. More importantly, they know that their portfolio has the earning power to recover. A few good years of market returns can erase that loss entirely. This ability to remain calm during a storm is a superpower. It allows you to avoid the single biggest mistake an investor can make: selling low. When fear takes over, people liquidate their holdings at the point of maximum pessimism, locking in their losses and missing out on the eventual recovery. An investor with a substantial portfolio has a psychological buffer. They see the dip not as a catastrophe, but as a temporary sale. They know that the shares they continue to buy with their monthly contributions are now on a discount. They are not just weathering the storm, they are using its winds to their advantage. This sense of calm comes from a place of security. With a $250,000 or $300,000 portfolio, you are no longer living on the financial edge. You have a cushion. Even if the market stays down for a year or two, your life doesn't have to change dramatically. Your financial future is not in jeopardy. This security allows you to detach emotionally from the day-to-day gyrations of the stock market. You can zoom out and look at the 10-year chart instead of the 10-minute chart. You have earned the right to be patient, and that patience is what will ultimately ensure your long-term success. If you are reading this and you have not yet reached the $250,000 milestone, it is easy to feel discouraged. You might be in the middle of that long, hard slog, pushing your own boulder up the hill every single day. You might be looking at your small account balance and wondering if it will ever amount to anything meaningful. You might feel that the finish line is a lifetime away. I want to tell you one thing: keep pushing. The part of the journey you are on right now is the hardest it will ever be. Every successful investor you admire has walked the same path and felt the same doubt. The beginning of the wealth-building journey is a test of character, not a test of intelligence. It's about consistency, not cleverness. It's about the boring, unglamorous work of spending less than you earn and investing the difference, month after month, year after year. The growth is so slow at first that it feels broken. It's not. The system is working, but its effects are microscopic. You are laying a foundation one brick at a time. It's only later, when you look back from the top of the wall, that you can appreciate the structure you have built. Do not compare your beginning to someone else's middle. When you see stories of people whose portfolios are earning them tens of thousands of dollars a year, remember that they, too, once had a portfolio that earned them just a few hundred. They, too, had to pack their lunch and skip the fancy coffee to save their first $10,000. The only difference between you and them is time. They have simply been rolling their snowball for longer. Your snowball is still small, but it is growing. As long as you keep rolling it, it is mathematically destined to get bigger and faster. So, be patient. Celebrate the small victories, like hitting your savings goal for the month, or reaching your first $10,000. Trust in the process of compounding, even when you can't see it working. The effort you are putting in now is not linear. You are not just adding dollars, you are building a machine. And once that machine reaches a certain size, it will start to run on its own, working for you even when you are not. The climb is difficult, but the view from the top of that first big hill is more than worth it. It's the moment you stop pushing a boulder and start riding an avalanche.